right. We are now live. Thanks everybody for joining us. Give it a few minutes while we let everybody get connected, and we'll get started with the show in just a few minutes. Thank you all for tuning in early. So we got some people in the chat. Let me throw that up if you guys want to throw anything in the chat. If you guys have any questions, once we go over the detailed topics for today, please feel free to throw a comment in, and we'd be happy to get to it. Good morning, everybody. I saw Christina put a question in there. Is the link different each morning? Yes, the YouTube link or the LinkedIn or wherever you guys are watching is going to be different every morning. So just make sure you check back in. Again, thank you everybody for joining us. We'll give a few more minutes, let everybody get connected, and we'll get started here in just a moment. All right. Looks like we are live everywhere now. Thanks everybody for tuning in. Going to remove the chat now. Again, if you have any questions about our topics today, feel free to drop a comment on the social network, and we'll go ahead and get into that a little bit later. And thank you everybody for tuning in. Well, let's get started with today's show. All right. Welcome, everyone. My name is Nick Hiersche. I am the president of the Mortgage Calculator. We are a lender that specializes in non-QM and alternative financing programs, which is one of the examples we'll go through today with our Condotel mortgage loan programs, as well as conventional FHA, USDA, VA, all of the standard stuff as well. So I'd like to thank everybody for joining us this morning. It is February 15th, just after 11 a.m. Eastern Time. And we now have live rates on over 4,000 loan programs that we have. So we're going to take the time today to go through a few of our standard programs with our pricing tool, which I'll do a presentation on. And then I'm going to present Jose Gonzalez, our sales manager with over 27 years of experience, to go through our detailed example here today, which is going to be on Condotel loans. So we did a condo, non-warrantable condo episode earlier. This is a slightly different variation of that. A Condotel has a very specific definition, so we'll let Jose get into the details on that in a little bit. And then we'll close it out with letting everybody know how to get with our team to get a full detailed quote like Jose will present at the end. But let me go ahead and get to our regular segment here. Let me pull up our pricing tool and we'll check out our live rates for today. Give me 1 second. Let me switch my screen. Move this around. And here we go. So this is our pricing tool. This is for our loan officers, our mortgage professionals. So if you would like to get a detailed full loan estimate with all the costs detailed laid out, please get with our team. We have over 300 licensed loan officers in over 20 states for primary second homes. And we can do our DSCR investor loans and fix and flips and all the crazy investor products in almost every state in the US. So please go with our team. We'll give you a very detailed quote. But this pricing tool here is going to give us the general indications for the market today. So again, today is February 15th, just after 11 a.m. So all of our standard programs are live here in the pricing tool, and we can check out what the markets are doing. So as we do every morning, we're going to start off with a conforming conventional example for a primary home. Then we'll go to an FHA loan example for a primary home again. And we'll do the same scenario again under expanded guidelines, AKA non-QM, which is where our team really specializes and gives all kinds of alternative programs. We have over 4,000 loan programs under expanded guidelines. What we will not go over today, our VA. If you are a veteran and you do qualify, we appreciate your service. Please get with our team. We'll quote that in just a few minutes. But since not everybody qualifies, we won't do it live today. And same with USDA. If the property is not in a rural area, it will not qualify for USDA. So if you are shopping in a rural area, please get with our team. They can quote this just as easily. But since not everybody qualifies, we won't do it live today. But as we do every morning, let's start with our conforming conventional programs. We're going to start with a basic scenario that we're going to use for all of our examples. We're going to do an 80 LTV loan. That's 80% loan, 20% down payment. We're going to search for a desired price of 99. What that means is we're going to look for the best rate at one discount point in cost. Most of our customers are asking to buy down the rate slightly. So that's going to give us an example at one discount point is what we're going to search for. And we're going to set up our standard scenario for purchase, 30-year fixed, primary, single family, 1 unit, Florida, Miami-Dade. That's where our office is based. And for all of our examples here, we're going to use a 760 FICO score and a 40 estimated debt to income ratio for all of our examples. So now let's check out what the rates are this morning. A lot of action in the markets here with the Fed and the CPI and stuff. So we're seeing a lot of movement on these conventional rates. So as we do every morning, these Home Ready and Home Possible programs are specialty programs for borrowers under an area median income. So let's cruise down to the first standard program that anybody can qualify for so we can compare. Looks like the first option here is this Fannie Mae option for this program. And the rates have gone up a little bit since yesterday. So we see a 6.625 rate for 0.875 in cost of discount points. So we like to watch this every morning and see the rates go up and down live. You'll see they're a little higher than they were the last couple of days. Hopefully you guys locked your deals in. And if not, continue to watch the show and we'll watch as the rates start to go down. Now, our next example here, let's go back to the pricer. And if a customer doesn't qualify for a conventional loan program, either Fannie Mae or Freddie Mac, we typically go to the next best option, which is our FHA programs. So FHA allows a little bit of expanded guidelines on a lot of the credit stuff and, of course, a higher DTI, debt to income ratio. So borrowers who might not qualify for conforming can oftentimes qualify for FHA. So we'll keep everything else the same, 30-year fixed, primary, 760 FICO, 40 DTI, everything else the same as we just did. And let's check out our FHA rates this morning. So it looks like they've gone up a tad since the last episode. So the best combination the computer found here was a 5.625 interest rate for 0.875 in discount points for cost. As we say every morning, remember when you're comparing FHA to any other loans, there are additional monthly mortgage insurance and whatnot. So make sure you look at the APR over here on the right-hand column so that you compare apples to apples across the programs. Now, if a customer does not qualify for FHA for some reason or another, many lenders or banks do not have other options. And that's where we really specialize. We have over 4,000 loan programs under our expanded guidelines, aka non-QM. So if a customer doesn't qualify for conforming or FHA for some reason, we can use our alternative income documentation under expanded guidelines. So we pull up the same exact scenario, an 80 LTV purchase for a primary home. And you see we get one additional option here now for non-QM. And this is where all the magic happens. We can do full doc, which is obviously, let me scroll down a little. Full doc is where what we use for conventional and FHA. That's for full tax returns. But you see we have dozens of other options here. We can do 1-year alt doc, 2-year alt doc. We can do asset related with no income job at all. We can do business bank statement, 12, 24 months, very common. Our investor programs here for the DSCR no ratio are amazing. We'll go over those in a minute. And our most common requests for alternative income are our personal bank statement 12-month programs. So we'll use this for our example this morning, the most common request we have. And that's going to be from a self-employed borrower. So we'll tag self-employed here. We're going to use 12 months of their bank statements in order to determine their debt to income ratio. So a lot of our borrowers who might not qualify with their full tax return because they're self-employed and they have some various write-offs, we can determine their actual cash situation by determining with 12 bank statements what their actual cash debt to income ratio is going to be using those bank statements rather than full documentation income. So a lot of great options here. Let's check out our non-QM bank statement options. So you see here the computer, the best price. Obviously, these have gone up a little bit recently, but the best option the computer found here was a 7.75 rate, a little bit higher than conventional. But again, these are for borrowers who would not otherwise qualify. And this is for a 0.625 in discount point cost. So some low cost there. This is a great option. And as you'll see in a minute, Jose can obviously break down more rate options on typical programs. These are just the most common quick pricing options we have here for today. And we love to check out all these options. And if we scroll down here, you'll notice we have dozens and dozens of programs that work with bank statement income. So again, we have thousands of programs, and with 12-month bank statement, we have just dozens just here, just for this scenario. Please get with our team to navigate which one of these programs may work best for you. Some of the ones at the higher rates that you see there may allow things like a credit event, like a bankruptcy or a recent foreclosure, and other things that would disqualify us from most other programs. So please get with our team. We love to work on these programs and find the best one that fits your scenario, and we would love to help you out. Now, before we pass it over to Jose, we always want to go through one other scenario, which is for our investment properties. So we're always going to compare our investment properties every morning with our conforming or conventional versus expanded guidelines. Remember, FHA via USDA, not eligible for investment properties. So we're simply going to compare a conforming example to our non-QM examples. So let's pull this up to a standard scenario. Again, for an investment property, 80% loan to value, 20% down payment, pretty standard. For, again, purchase, 30-year fixed. Everything else is going to be the same as our other examples. And let's check out what the investment property rates are for conventional. So looks like we have some options here, a little bit higher than they were the other day. So again, the markets do change. Looks like we have a 7% interest rate for 3 discount points and costs is the best combination the computer found here. And that is because the GSEs have added an additional loan level price adjustment for investment properties over the last year or so. So we do not, unfortunately, have any 1 discount point in cost options. All of the investment properties under conforming do have a very large price adjustment there. So we do not see any options for lower discount points. Even though our investors often ask to go up in rate, you'll see here, even if we go up to, for example, this might be a better scenario. So 7.125 rate for 0.27 or 2.75 in discount point cost. So that looks like the lowest combination there. But again, our investors oftentimes want to save cash out of pocket. So they like alternative options. And that's where we specialize at the Mortgage Calculator. These are great options for our borrowers that qualify for full doc and for conforming. But we love to compare that with our non-QM expanded guideline options. So let's pull up a scenario for that. Again, 80 LTV loan, 20% down payment, investment property. But now that we've done expanded guidelines investment property, there's a couple new options that pop up here. So everything else is going to be the same, but we do have to select our income verification. What non-QM program are we going to do? And for our investment properties, our most popular program by far is our DSCR program. And that is because it actually does not require any income verification. No employment, no income verification from the borrower. We're simply going to use the property rental income to cover the mortgage payment, the PITIA of the mortgage, and determine if that property will cover the payment for that property and not have to worry about the borrower's income. So these programs are amazing. And we even have options for properties that maybe don't cash flow. So that would be a no ratio DSCR, all the way to amazing options for properties that cash flow greater than 1.5 or even higher, right? So if you have a property that cash flows amazing, these programs work great. So we'll check out our DSCR programs. And the other option that always pops up with non-QM investment properties are prepayment penalties. It's pretty standard. Of course, we can have no prepayment penalty. That's going to be a little bit more expensive. All of our examples are typically priced with a 3-year prepayment. That's pretty standard. And we can even increase that to 5 if we want to save a little bit more money if you're going to hold a property forever or for a longer time. So 3 years pretty standard. We'll do that as we do every day for our scenario. And let's check out our DSCR rates this morning. So the top option here looks like an 8.625 rate for 0.975 in discount point cost. And as you can see here, there are a ton of options with different DSCR ratios, different prepayment penalties. So please get with our team to find which of these dozens and even hundreds of options that we have will fit best for you. For example, some of the ones with the higher rates that you see there may allow short-term rental income, which we've done a couple of episodes on, and we love to help our investors purchase short-term rental properties, Airbnb, VRBO, all that kind of great stuff. So a lot of great options under DSCR, definitely our favorite programs by far. Work great for first-time investors. If you're getting your first rental property, it's still a great option. or for investors that have 10, 20, 100 properties, we can quickly refinance a couple properties, quickly purchase new properties without worrying about income documentation and all that. Simply have to get the appraisal and the appraised rent value, and we can rock and roll. So we love these programs. And I believe Jose is going to give a little bit of an example of a Condotel with a DSCR. So let me switch over to Jose here in a minute and introduce our deep dive topic for today. So give me 1 second. Let me change my screens and we will get into it. So today's deep dive topic is going to be on Condotel loans. So I want to make sure Jose gets the time to explain exactly what's the ins and outs there of the Condotel programs and what makes a Condotel, right? There's a very specific definition. A lot of properties in South Florida do fit that definition. So Jose has dealt with a lot of these. And they are a specific niche of the condo financing, right? So we talked about non-warrantable condos. Now we're going to talk about Condotel, which is kind of a separate category. They're still most likely non-warrantable. So they're under the condo umbrella. They're going to be under the non-QM umbrella. And they're going to be typically under non-warrantable umbrella as well. But very specific programs. And there are a lot of them. And especially as short-term rentals increase in popularity, a lot of new buildings are coming online that sort of fit this definition as well, especially in South Florida. So let me go ahead and introduce Jose, our sales manager here at the Mortgage Calculator with 27 years of experience, and he can go into a deep dive on the Condotels. Let me make you a little bigger here, Jose, and you can take over.
All right. Good morning, everybody. Jose Gonzalez here, sales manager of the Mortgage Calculator, licensed since 1997 as a realtor and a loan officer. Condotels, really interesting topic, especially for the Florida market, because we do have a lot of second home and vacation rental type properties here. So, what exactly is a condotel? Well, you can probably tell by the name that it must have something to do with hotel, right? Where they combine condo and hotel to condotel, right? But so condotels are able to be financed, but there are just certain parameters that have to be taken into consideration, and the loan has to be structured, a certain way to even be able to have a chance to do it. Because condotels tend to be predominantly occupied by second homeowners and tenants, so your percentage of actual primary occupants in a condotel is typically going to be below the minimum that would be required on all full review condo loans. So that's the first, I guess, red flag. There is full review versus limited review, which means that every condotel loan has to be done to begin with, to stand a chance, has to be done as a limited review process loan for condominiums. That's the first step, which means that the condo questionnaire that is going to go out to the association or the management company, whichever is the one responsible to complete that form, would be the limited review condo questionnaire and not the full review. What does that mean, actually? Limited review versus full review. Well, it means exactly what it is. On a limited review, we're going to review less parameters of the loan. So we're not going to review the ones that typically are going to bring us problems. For example, we're not going to have to review the budget, right? So we're not going to have to determine if there's reserves. We're not going to have to be concerned if there's any delinquent accounts in the collection of the budget, percentage of delinquent account. We're not going to have to worry about percentage of owners to renters either. So notice how all these things start dropping off of the list that will give us problems. The main things we're still going to have to be concerned with in the condo is Does one entity own more than X number of units? Because that may be an issue. That's where we're talking warrantable versus non-warrantable. And is there any litigation? Those are the two main things that they're always going to be concerned with. There's ways to address those as well, but those are the two components that are always going to stay on the condo review, along with reviewing, the insurances to make sure that they're adequate, basic stuff like that, because the property needs insurance. So that's one of the things that's taken into consideration. But the other thing then, which is where the Condotel component comes into it, is, for example, the size of the subject property must not be less than 500 square feet of living space, right? The unit must have a full size kitchen and a separate bedroom, no studios with kitchenettes usually. However, now talking about kitchenettes, units with kitchenettes are considered on a case by case basis. So don't be discouraged automatically if your unit has a kitchenette, because I mean, if it's in the Fontainebleau, Miami Beach, and it has a kitchenette, send that one in for review. It may be acceptable, right? Uh, so the kitchenette can be marked in the appraisal or identified by the underwriter. So your appraiser may not make a note of it, but the underwriter may make a note of it if one of the following features are missing. This is why it's so important you vet the property in these cases. If the property is missing a refrigerator, if the property is missing a 4-plate stove, in other words, 4 burners, a 4-burner stove with an oven, so not just like a 2-burner insert on top of the counter, may not or may work, but off the bat, the red flag comes up if it does not have a 4 burners range with an oven. Also, if it does not have a sink, or if it does not have countertops. Any of these components individually missing is an alert. Refrigerator, 4-plate stove with oven, sink, or countertops, right? Projects cannot contain the word motel or hotel in the name, right? Uh, and here's another real big one that tends to catch some people off guard because you don't necessarily find out about it unless you really dig deeper. Projects cannot have mandatory pooling agreements that require unit owners to either rent their units or give a management firm control over unit occupancy. So if it forces the owner to always rent the unit, obviously not be able to occupy it, or give management firm control over the unit occupancy, then you're going to have an issue. And that does happen in some condotels where you have to put it into the hotel program, quote unquote, and then they limit you to a certain amount of occupancy during the year. Those are issues that probably will render your loan not doable as a condotel. And then, last but not least, condotels cannot be rural or be located on agricultural zoning. I mean, that's usually not an issue with condotels, as they tend to be more, like waterfront or something in a ski resort or something like that, right? So again, I have those considerations here. Now, the first option that we're going over is for a 70% LTV, because also the maximum LTV on the condotels is 70%, at least with this particular program that I'm looking at, is 70% LTV. And it is going to be investment only, no primary or second home in this program I'm looking at for a condotel. Investment only, 70% LTV, which is also the maximum for our limited review condo also. So I'm sure they limit it to 70% LTV because that is the limit for an investment property condo to be able to be processed as a limited review loan. Now, that's a Fannie Mae requirement, and they follow the Fannie Mae guidelines. And that's the most restrictive Fannie Mae guideline because that's the Florida condo guideline. This condo happens to be in Florida, but the non-QM loans are typically going to follow the more restrictive guideline for Fannie Mae condos, which state investment limited review is 70% and primary limited review is 75, even though they do not do primary on this loan. So the first option we have is an investment full doc. So this is full doc, really good rates here at a 70%. Now this is non-QM. This is not Fannie. Uh, Fannie, Freddie, agency basically do not allow condotels at all. They don't care about if it fits this or if it fits that. If it's a condotel, it's an automatic not going to make it. So here, lowest cost rate, very good, 8.125 at par. Very good rates here. And let me just put this into context here. Our loan amount is $350,000. So you're looking at about 2.875 as the lowest buy down option. There was another buy down option, but it was more than 3 points. So I really wanted to keep these options under a total of 3 points cost. So this full doc purchase 8.125 to 7.125. The beauty of this is that we can do pretty much every income type through the Condotel as long as we look at the property parameters set for us and we stay within those guidelines. So now, bank statement option, and I want you all to note that the bank statement option for income verification is pretty much the same as the full doc option using tax returns, because for non-QM, bank statements is full doc. We're just using bank statements instead of tax returns to verify the income. So if we go back to our full doc option, you'll notice it's 8.125 at par, right? And our bank statement option is 8.25 at par. And at 8.125, it's costing us like a quarter. So really at this point, if you're contemplating which way to go here and you have options, I think it would be pretty obvious that it would probably be bank statement rather than full doc, unless your borrower really wants that 0.1% lower rate. Now DSCR, not that much of a change either. Again, these are all at same LTV, same credit score, same property type, same everything. The only thing that has changed for our condotel financing is the income type being used. So here we are 8.49 at par. So we had 8.25 on the bank statement, and we had 8.125 on the full doc using tax returns. So these are three good options for a purchase, but there's more. Now we're going to go with a refi cash out using bank statements, right? So same parameters for the property, nothing changes. The only thing that changes is that the maximum LTV for a condotel is 65% when you're doing a cash out refi. That's all income types. That's strictly a property related overlay, because that's really what it is. So over here, again, pretty good rates. Obviously, they get a little bit better when the LTV drops a little, but here we're looking at cash out refi, 65%, 8.375 at par. Very good rates, considering you wouldn't even be able to touch this on a Fannie Mae loan. And if you were to go put a Fannie Mae investment at a 65 cash out on a property you could do, I would assume that the rate was not going to be much lower than what you have there, maybe even a little bit higher. So now DSCR, same scenario, 65% LTV. And again, really good option, 8.625 is at par. And again, what was my bank statement? Was 8.375. So we're going DSCR on this bad boy at a 65% LTV, cash out refi, DSCR, and Condotel that could probably also is non-warrantable. We're here 65% LTV, cash out refi, which are amazing rates and amazing programs. I think that the DSCR rates may have even dropped a little bit today versus the conventional rates because we have some good appetite in secondary for the product. They love the DSCR. They love the security the program offers. They love not having to deal with anybody's tax returns. They know what the property is going to rent for. I mean, they are empowered, which is why the secondary investors are just gobbling up these DSCRs, voracious appetite for these. So definitely looking forward to structuring these deals, helping the team structure these deals, helping our customers structure these deals, all our investors out there that thought that they had no options. At the Mortgage Calculator, we do specialize in providing solutions for all of these difficult situations where other people say no and see obstacles. We say yes, and we provide multiple solutions to our investors and our MLOs. So come on board and join the fun.
Beautiful. Well, thank you, sir. That was a very deep dive. So hopefully you guys understand a little bit about the difference between condotels and non-warrantable condos, and of course condos with limited review. It's definitely very complicated. Please get with our team if you have any questions on that. And our team, we have over 300 licensed loan officers in 20 states for primary and second homes. For investment properties such as a condo hotel for our business purpose DSCR, we can do those in pretty much every state in the U.S. for those business purpose loans. So if you'd like a detailed quote, please get with one of our loan officers. If you don't have one yet, please go to themortgagecalculator.com. It's right below me here in the screen. And you can go ahead and price your own DSCR deal or just request a quote, and one of our team members will get right back to you. We can typically quote most of our stuff within 5 minutes, especially for the standard programs that show up in our quick pricer. So please get with our team if you need a quote, and check out our show tomorrow. We do the show every weekday at 11 a.m. Eastern time, and we will check out the daily rates again tomorrow. Thanks everybody for joining us today, and thank you, Jose.